Should married student loan borrowers file joint or separate tax returns? It's a tough question and there's no easy answer, but if you follow these steps, you're going to make the right choice every time. Today, we're going to assume that you have federal student loans and your spouse doesn't, or vice versa. If you both have federal student loans, that's going to be another video because it's a lot more detailed. But in general, there's only one correct way to decide. You run the numbers on both sides of the ledger. What changes in your student loan payment if you file jointly versus separately? And what changes in your federal and state tax bill under both scenarios. Under the current income-driven repayment plans, that's IBR, ICR, and pay-as-you-earn, if you file married filing jointly, your payment is going to be set using your income and your spouse's income. But if you file married filing separately, your payment is set only using your income. So married filing jointly means a higher payment than filing separately. But and this is the part that most people forget, married filing separately usually raises your taxes, which is why the first step that we're going to take is to perform a tax projection. Now, tax projection involves drafting your income tax returns both ways to see the difference in your adjusted gross income and your tax bill. Now, you should have a tax professional do this because they're trained to handle these types of issues, and you don't want to mess this up. But once you have the projection done, you can move on to step 2, and that's to calculate the student loan payment both ways. Determine your student loan payment using combined household income, then calculate the payment using only your income, and then use that information for step 3, which is lining up those payment calculations with your total household tax obligations both ways. And then step 4, you calculate the total cost under each scenario. To do that, multiply the monthly student loan payment by 12 to get an annual figure. Then you add your total federal and state taxes if you file jointly, and you compare it to the household total federal and state taxes if you file separately. If the total balance is lower by filing separately, do that. And if not, you file jointly. Whichever is lower is the way that you go. But please don't overcomplicate this. This is a this year decision. You could file jointly one year, file separately the next, and switch back and forth depending on the math each individual year. The right decision is based on your total out-of-pocket payments and your total tax costs. If you don't run both tax returns and both IDR calculations side by side, you're not making a strategy, you're guessing, and guessing costs money. If you've got questions about your federal student loans, your private student loans, or any other debt whatsoever, as always, get in touch. You know where to find me.